Hello, and thank you for joining us once again for our International Market Update video for March 2024. The economic data this month continued to confirm a soft landing as the base case in the US, and consequently, markets also followed suit and had a positive month. Inflation data was essentially in line with CPI at 3.2% versus 3.1% expected, and PCE came in at 2.5% year-over-year, exactly in line with expectations. Q4 GDP numbers actually came in above expected at 3.4% versus 3.2%. And while there are still some pockets of weakness in the data, namely housing and manufacturing, they too seem to be bottoming, and most importantly, the variables that have led economic strength, wages, employment, and consumer spending remain very robust. As mentioned earlier, equity markets responded quite favorably to the data set this month. The S&P 500 continued to make new all-time highs, closing up 3.1% for March, and brought its total rally quarter to date to over 10% for only the 11th time since 1950. The market closed at 52.54, exceeding most of the sell-side analysts' forecasts for the entire year. So on the markets front and on the economics front, it has been a very solid start to the year, and while we are not out of the woods yet for a tail risk soft landing, all eyes are on unemployment data, there is confidence that we continue to take further steps to confirm a soft landing. On the inflation front, this month's Fed meeting confirmed that the committee remains data dependent. That said, despite numbers having come down significantly from their peak as discussed earlier, inflation has been somewhat sticky at current levels and slightly above the Fed target. For now, consensus remains unchanged with the expectation that the Fed will start to cut rates in June of this year. So what else are we looking at? Well, at this point, markets are turning their attention to the election. Given Donald Trump has already won the Republican nomination by dominating the field and securing his name on the presidential ballot alongside Joe Biden this March, this is the earliest that primaries have wrapped up, and in a primary season, as far as I can remember, it sets up what's going to be essentially the longest election cycle in recent history. Which brings us to the question as to how politics affect our investment committee. In short answer, it doesn't. This is not to say that the projected winner of the White House doesn't influence sectors and themes. It does. But our view is that over time in the US, at the aggregate level, market dynamics are not shaped directly by politics, nor will we change our tactical calls based on polling. That said, we'll still spend some time every month through the election cycle highlighting some of the topics where the candidates differ and that can influence markets at the margin. This month, I'll talk about the size of the budget deficit. This has been an important focal point because the larger the budget deficit, the greater the US's need for funding, and therefore the greater the issuance of debt. This is at the margin negative for treasuries and should lead to higher rates, all else the same, as well as a weaker dollar. Again, all else the same. And believe it or not, the belief is that both Biden and Trump are, well, expansionary for the budget deficit, so to speak. For very different reasons, both will lead to higher budget deficits. Trump will likely cut taxes in the short term, while Biden is expected to maintain a high level of spending, one that exceeds tax revenues. So in the case of the budget deficit, they have the same outcome for very different reasons. Each month, I will discuss a hot topic on politics and how it affects the economy. Thank you as always for tuning in this month, and look forward to seeing you next month.